This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. Okay, I'm going to go through the paper F9 specimen exam. And so make sure you've got a copy of the exam in front of you. You can download it from the ACCA website. Before I do though, just a few general bits of introduction. Remember, you have two sections to the exam. Section A is 20 multiple choice questions, and each of them carries 2 marks. Section B, you have 5 questions, totaling, you can work it out yourself, totaling 60 marks. 2 of them will be for 15 marks, 3 of them are for 10 marks. So that's the way a specimen exam is, and that's the way the real exam is going to be in terms of the structure. Remember, you have 3 hours, you've got 15 minutes reading time before you start the exam, and during those 15 minutes you can read the paper. I would spend a few minutes looking at the requirements of section B, just to be clear what topics are being asked, perhaps what order to do them in. Otherwise, by all means, you can start the multiple choice section. You can write on the question paper, so you can start doing workings, all sorts of things, but you can't actually write in the answer booklet until the exam proper starts. Remember, when you do start answering them, section A, nobody looks at your workings. So although for some questions you will need to do workings, don't waste time being neat. There's a time issue, you've got to be as fast as you can. So again, nobody looks at your workings, it's computer marked. And all they mark is the answers you put on the sheet. There's a special page in the beginning of the answer booklet where the numbers of the questions are down the side. Against each, you've got 4 blobs. And what you have to do in black ink is, if, for instance, you think the answer to number 1 is A, you fill in the blob for A. If you think the answer to number 2 is B, and so on. If for any reason later you want to change your answer, you put a cross through the original one and heavy in the correct blob. But you must fill in that sheet. If all you've done is written answers on the answer paper and nothing else, it won't be marked. If you've listed the answers on a separate page in the answer sheet, they won't be marked. It's that sheet must be filled in. Finally, particularly for the multiple choice, remember you can do questions in any order. And the examiner himself says, and it's the same for all of these multiple choice exams, although they're all 2 marks, they are different levels of difficulty. Some of them, as we're going through, some of them I think are very quick. Maybe, depends how much you've studied, maybe very easy. Others are definitely a lot longer and potentially harder, but they're still only 2 marks. And so although, by all means, start doing number 1 first, number 2 second, and so on, don't fall into the trap of perhaps getting to number 2 and spending 20 minutes and still not being able to get an answer. If you're stuck, if you find you're having problems with the question, if it's a lot to read, if it's something you know you're not very good at, if you can't get the right answers, leave it, carry on. Your job is to try and get at least 50% on section A, at least 50% on every question in section B. That's what you're aiming for. Anything extra is a bonus. And so with the section A, go as fast as you can, ignore any hard or long ones. If you have time left at the end, then you can come back and fill in the missing ones. Incidentally, don't misunderstand me, the pass mark for the whole paper is 50%. And it's just the overall mark. But sensibly, aim to get at least 50% on section A on every question in section B. That's what you're aiming for. Hopefully, some of the questions you'll be able to get a lot more than 50%, and then you'll pass easily. Okay, I'll leave that at that, and then we'll start going through, first of all, section A. Okay, let's go through section A of the exam, the multiple choice. And I did say earlier, if you watch the introduction bit, that make sure you've got the exam in front of you, obviously. But let's start going through them. Question 1, a short statement 1. And instantly, when it's one of these, when it is fairly short, have a read. They're one where either you know the answer, tick it, or you don't know the answer, in which case guess. However, in relation to hedging interest rate risk, which of the following statements is correct? A says the flexible nature of interest rate futures means they can always be matched with a specific interest rate exposure. No. I can't give a lecture here. If you need, look at the lecture on the website on interest rate futures. But it doesn't match it with a specific rate exposure. No. B, interest rate options carry an obligation to the holder to complete the contract at maturity. No. The whole nature of the option is you've got the right to complete the contract, but it's your choice. C, forward rate agreements are the interest rate equivalent of forward exchange contracts. Yes. You're fixing a rate to apply on a future date. The answer is C. If you're confident, move on. Otherwise, let's here just check D. Matching is where a balance is maintained between fixed rate and well, no. I can't really say any more. It's nothing to do with it. So the correct answer is C. Number 2. Well, here we're going to need a bit of arithmetic. Always look at the requirement first, and you don't waste time. But what is the 6-month forward exchange rate? And if you look back at the body, the home currency of ACB is the dollar. Trading with a company in a foreign country whose home currency is the dinar. We know the spot rate, 20 dinars to the dollar. We know the interest rates in both countries, and we know the inflation rate. Well, appreciate here it asks for the forward exchange rate. The forward exchange rates are always determined by the relative interest rates. And so it's the interest rate parity formula from the formula sheet. F0 is S0 times 1 plus IC over 1 plus IB. F0 is the forward rate that we're after. S0 is the spot rate. Well, we told the spot rate, the rate currently is 20, and it's dinars to the dollar. And I mention that because people always have a problem in knowing I is the interest rate, but IC and IB. Well, the way I remember it, you'll know if you've watched the lecture. It may sound silly, but it always works for me. IB, I say B for base country. Here, the base country is dollar. We're quoting against the dollar. So many dinars rather to the dollar. And so, what's the interest rate in the dollar country? The home country is 3% a year. However, remember, we're after a 6-month forward rate, so we need the interest for 6 months. So if it's 3% a year, 3% over 2 is 1.5%, or 0.015. Similarly, IB, the base country, IC, the other country. Well, the other country, in the dinar country, it's 7% a year. For a 6-month rate, the 6-month forward rate, a 6-month interest rate, is 3.5%, or 0.035. And there we are. It's now just a calculator exercise. 20 times 1.035 divided by 1.015. Let's hope I'm right. I get 20 point, to two decimal places, they're the only choices we've got. 20.39. The answer is A. And remember what I said earlier, I'm trying to be neat with the workings so you can follow it. I hope it's neat enough. But in the exam, don't waste time. You will be under pressure and nobody will look at the workings. Anyway, number 3. Another arithmetic one. What is the sensitivity of the net present value of the investment project to a change in the sales volume? And what are we given? Well, they've given us all the present values, present value of the sales revenue, present value of variable costs, present value of contribution, and so on. And, well, I think by now you should have learned it as a rule. I'm not going to keep saying, but it's all in the free lectures. And to get the sensitivity, we take the NPV of the project, we divide by the present value of, I'm not going to use posh English, it's whatever changes. And to explain what I mean by that, well, the NPV of the project, that's no problem. In this question, it's 1,300. Actually, everything's in thousands, but no problem there. But it's over the present value of whatever changes. Well, we're asked for the sensitivity to the change in sales volume. If the sales volume changes, the sales revenue will change. Equally, the variable costs will change. Therefore, contribution will change. But of course, a change in the sales volume won't affect the fixed costs, won't affect the initial investment. And so what's going to change is the contribution. Present value of it is 24,550. And so I express it as a percent. 1,300 divided by 24,550 is 5.30%. The answer is D. In fact, strictly, the answer is minus 5.3. The reason being that, you see, if sales volume increases by 5% or anything, if sales volume increases, things can become better and better. It's only if the sales volume falls that we risk having a problem. We can afford it to fall by up to 5.3%. So strictly, it should be negative. He hasn't given that choice. We've just got the figures. The answer is D. But if he did say, you know, if C perhaps was plus 5.3 and D was minus 5.3, well, the answer would be D. Let's move on to number 4. Working to one decimal place, what is the total shareholder return over the period? And if we look at the body, TKQ has just paid a dividend of 21 cents a share. The share price is $3.50 a share. 1 year ago, it was $3.10. Well, to get the total shareholder return, we say, well, how much have they benefited over the period? They've had a dividend over the period of 21 cents, or $0.21. In addition here, there's been an increase in the market value. At the beginning of the year it was $3.10, at the end of the year it was $3.50. So an increase of 40 cents or $0.4. So in total they're benefiting to the tune of 61 cents. As a percentage, we express it as a percent of the market value, the share price, of the start of the year, which was $3.10. And so total return 61 cents on $3.10 is 19.68%, or well, obviously he's put it to one decimal place, 19.7. The answer is D. Number 5, a little statement one, and here a very quick one, like that earlier one. You either know the answer and you tick it, or no point in wasting time. If you don't know the answer, you make a guess. If you're lucky, you'll get the 2 marks because you've guessed right. To what extent does Gurdip believe capital markets to be efficient? And you've got those choices: not efficient, weak form efficient, semi-strong, strong form. It says Gurdip plots historic movements of share prices and uses this analysis to make her investment decision. Well, efficiency is the degree to what information they've got about what the business is doing. Here, she's using no information at all. It means, it suggests that she believes it's not efficient at all, A. So that went number 5. All right, let's carry on with number 6. Which of the following statements concerning capital structure theory, capital structure, the level of debt and equity in a business, is correct? In the traditional view, there's a linear relationship between the cost of equity and financial risk. No, the traditional view is quite simply that as there's more gearing risk, cost of equity will increase. But there's no suggestion that it necessarily increases linearly. We just assume it will increase with more risk. So it's not, what was it, A? B, Modigliani and Miller said in the absence of tax the cost of equity would remain constant. No, it's a trick when you read it too fast. They say in the absence of tax the weighted average will remain constant. The cost of equity, though, that will, according to them, that will increase. So it's not B. Pecking order theory indicates that preference shares are preferred to convertible debt. No, pecking order theory says that they raise finance in the easiest way. In fact, they suggest that preference convertible, it's the other way around. D, business risk is assumed to be constant. Yes, we do assume the level of business risk doesn't change. That's due to the nature of the business. The capital structure, it's the gearing that's creating that extra risk for shareholders. The answer is D. Number 7. What's the impact of a fall in a country's exchange rates? Now, there's never going to be many of this type of thing, but it's more background reading coupled with, I think, common sense. If the country's exchange rate, if it falls, number 1, exports will be given a stimulus, yes, because it means that foreigners, in their currency, will find our goods cheaper. If our goods are cheaper, well, it's like to stimulate exports. So number 1 is true. Number 2, the rate of domestic inflation will rise. I hate when he says will. It's likely to rise. It's because, for the same sorts of reasons as number 1, not only does it make our exports cheaper for foreigners, but it makes imports more expensive. Imports in foreign currency become more expensive, and that's likely to push up inflation. So it's 1 and 2. The answer is C. Number 8. Another statement 1. Which is the following is least likely to increase the shareholder's wealth? So least likely. A, the average cost of capital is decreased by a recent financing decision. That is likely to increase the wealth, because if the cost of borrowing to the company is lower, it's likely to make the company worth more. And if the value of the company goes up, the benefit will go to the shareholders. So that is likely, in fact, to increase wealth. The financial rewards of directors are linked to increasing earnings per share. That could increase the wealth, perhaps. Because if we increase earnings per share, ultimately that stands hopefully to increase the wealth of the shareholders. So it could be that one. Sorry, it could not be that one, perhaps. We'll see. It could increase the wealth. The board of directors decides to invest in a project with a positive net present value. Well, that certainly does stand to increase the wealth. There's not much argument there. D, the annual report declares full compliance with the corporate governance code. Corporate governance, that the directors are, there's a lot in it, but basically the directors are acting independent of themselves, and they are doing what's best for the shareholders. So which of them is least likely? I think the argument's between B and D. And overall, well, D should help to increase shareholder wealth. If the directors are doing what's best for shareholders always, that should increase their wealth. The least likely one is going to be B. And on top of it, of course, shareholder wealth, the value per share is determined really by the dividends they expect, which do link in to an extent with earnings. But anyway, although they could all increase the value, the least likely stands to be B. 9. Value for money is an important objective for non-profit organisations. True. Which is least consistent with increasing value for money? A, see, again, it's least, so they might all be consistent to a degree and increase value for money, but which is the least consistent? A, using a cheaper source of goods without decreasing quality. Well, that certainly should increase value for money. B, searching for ways to diversify the finances. I suppose that could increase value for money if they manage to get their money cheaper, their finance cheaper. Decreasing waste in the provision of a service, certainly that stands to increase value for money if you have less waste. And D, focusing on meeting the objectives. Well, look at the original statement. Value for money is an important objective. If they focus on meeting the objectives, then that should increase value for money. And so it's not going to be A, C or D. The least consistent is going to be B. Number 10. Which of the following Which of the following statements are features of money market instruments? Well, this really is reading the notes. Again, it's really more background. You wouldn't get many on this sort of thing. But you either know what they are or they aren't, to be honest. Number 1, a negotiable security can be sold before maturity. Yes, that's the nature of it. If something's negotiable, the word means that you're able to sell it, you can trade it. Number 2, the yield on commercial paper is usually lower than that on treasury bills. Commercial paper is things like bonds issued by a company. And in fact, the yield, the return, is likely to be higher than that on treasury bills. Treasury bills are issued by the government. The reason being that although bonds, government stock, treasury bills are both very low risk, there is that little bit more risk if investors buy bonds in a company, because there's more risk, obviously, of the company going bankrupt and losing your interest than the government going bankrupt. So the yield on company borrowing is likely to be higher, not lower. Number 3, discount instruments trade at less than face value. Yes, that's what we mean by discount. It's less than face value. So the answer is 1 and 3. The answer is B. Okay, so we've got half of them done. That was number 10.